And so we talk a lot about the war on savers. Is this the issue for people that are trying to retire with low rates?
It's certainly an issue. We're in a low-rate environment. Traditionally, those nearing retirement want to move out of riskier equities and into safer fixed-income securities, and they're not going to yield very much. And indeed, for a U.S. near retiree looking into Europe where there are negative rates, it's got to be a fairly daunting environment. And so the question is, how will people react to that, and will they end up sort of pursuing riskier investment strategies as they go into a near retirement?
Doug, so what kind of solutions do you think there are out there for people with this low rate environment? Because if you listen to some economists, right, the expectation is because of demographic trends, et cetera, maybe we're lower for longer. So what can a retiree or near retiree do to try and address this for themselves?
A retiree can take on more risk. You face a fundamental trade-off between expected return and risks, and that's something that retirees have to think hard about and decide whether they want to manage that risk. At the larger macro environment, as we think about policy toward retirees, I think it places a premium on doing the things that the nation can do to lean against the demographics, and that would include policies for better productivity growth and fiscal policies to deploy against the low-rate environment. I think the big difference between the U.S. and Europe is Europe's inability to deploy fiscal policy and generate better growth. We can and should.
Hey, Doug, Pross here. Talking about retirement, also talking about pensions. GE freezing those pensions for those workers. That sort of going away for a lot of people. How do you bridge the gap between the loss of those pensions that were there as a safeguard for people?
I think this is one of the really big issues that's sort of a sleeper issue at the moment. The sort of U.S. corporate effort on sort of defined benefit pension plans, that experiment's been run. And we don't have a very good safety net of defined contribution, 401ks and the like. And so we really have two big problems in the pension world. Number one, you've got the legacy problems where some of these multi-employer pensions aren't funded, company pensions aren't funded, and the PBGC, the Guarantee Corporation, has its own financial problems. And we don't really have a comprehensive strategy to replace those with defined contribution kinds of vehicles. That's a hole in the architecture and something that Congress really ought to think hard about.
You talked about retirees basically having to go and find more risk out there if you want the return. But there are so many clouds on the horizons. We have a trade war. We've got tariffs. We've got impeachment talk. Why do you think, I get tariffs and trade war really haven't hit consumer confidence yet?
And thank goodness, because the consumer sector has been the strength of the U.S. economy. It's 70% of the potential for near-term growth, and as long as it continues to grow somewhere between 2.4 and 2.8%, as it has, this economy will slow but continue to stay above zero. I think everyone watches those confidence numbers carefully. They've declined some. That hasn't yet translated into diminished growth in household spending. And I'll note this happened at the same time that the saving rate has risen. So they've managed to, as a sector, prepare better for the future, but also continue to lift the economy. That's a very good performance so far, but no guarantees for the future, given all the risks you mentioned.
Right. As you say, so far we have big talks coming up this week. If there's no deal, little deal, big deal, any kind of deal, do you worry about the knock on consumer confidence?
I do worry about that. We know that when tariffs are imposed, there's an immediate hit to the economy, and the tariffs imposed thus far have been designed not to hit the consumer very hard. After they're in place, people start to adjust their behavior and move things. We're watching the business community adjust supply chains all the time. So the real risk here is the next couple rounds. And if there's no deal and the president goes ahead with additional Chinese tariffs, which are largely targeted on consumer goods heading into the Christmas shopping season, that's a big risk, and that's worth watching carefully.
Always great to get your thoughts. Douglas Holtz-Eakin, president of the American Action Forum.